Let us see what DuPont analysis is all about. It is more than a century-old technique to evaluate the various factors that impact the profitability of a business. It was first introduced by the DuPont Corporation USA. One of their finance executives, Mr. Frank Donaldson Brown, invented this particular method of evaluating the factors that impact profitability of the business. He rather created something called DuPont Control Chart, which the company started using almost around 1920s to ascertain or to improve the ROI, or otherwise known as the return on investments. Basically, we use two ratios. One ratio is capital turnover ratio. Capital turnover ratio is sales divided by capital employed. Capital employed here means total of fixed assets and working capital. Working capital is nothing but current assets minus current liabilities. So here we know that current assets comprises of basically three things. One is the stock or the inventory. Secondly, accounts receivables. And thirdly, the cash and cash equivalents. And current liabilities also comprises of basically the accounts payable, the short-term liabilities, and of course the outstanding expenses like salary outstanding, wages outstanding, etc. Then the second ratio that we use is net profit ratio. Net profit ratio is calculated by dividing net profit by sales. So how do we get net profit? Net profit is nothing but sales minus total cost. And the total cost comprises of 5 different aspects. The first one, of course, is the cost of goods sold. Cost of goods sold is nothing but the total of all the direct expenses incurred for the production of the product. Secondly, we have got administrative expenses like salaries, maybe electricity bill, rent, etc. Then we have got depreciation, which is a non-cash expense, but it is a deductible expense. Then comes selling and distribution expense, the expenses incurred for the sale of goods such as advertisements, salesman commission, and all the other associated expenses. Then we have very important item, that is financial expenses. Financial expenses comprise of basically two things. One is the interest part of it. When you raise debentures for capital, you have to pay interest, a fixed rate of interest to the lenders. So interest becomes a financial expense. Then when we pay dividend to the shareholders, that is also considered to be a financial expense. Now, as I said, we have got two ratios, that is capital turnover ratio and net profit ratio. When we multiply capital turnover ratio and net profit ratio, we get return on investments. In essence, this is the DuPont control chart. But how does this help the executives or the owners of the business? Let us see. The company incurs a huge increase in the manufacturing expenses. That means that will affect the cost of goods sold of the business. When the cost of goods sold increases, it naturally results in the increase of total cost, which in turn affects the net profit, and which will lead to a variation in the net profit ratio, and ultimately it will affect the return on investments. If we find a change in the return on investment, negative or positive, we can easily locate which among these variables contributed to the variation in the return on investment. If it is an adverse variation, we can focus our energies on that particular aspect. Say in this example, it is the cost of goods sold, and we can rectify that and improve the return on investments. Similarly, any variation in any of these basic elements can have an impact on these secondary variables and these tertiary variables, and ultimately on the return on investments. So in this way, the financial executives or the managers or the owners, will be in a better position to identify what went wrong and where, and they will be able to initiate immediate corrective measures so that the return on investments will not be affected. Thank you.